Silver past $90 isn't a commodity headline, it's a system alert. And if any part of you thinks this move is random, speculative, or just retail hype, I need you to listen like your purchasing power depends on it. Because it does. Here's the claim that sounds extreme until you understand how the machine works. This isn't an accident. It's the predictable output of a pattern that repeats every single time a debt-based system grows so large it can no longer tolerate honest interest rates. When that happens, the system faces a choice between two kinds of default: an open default, bankruptcies, austerity, chaos visible to everyone, or a quiet default, diluting the currency until the debts become lighter in real terms. And because open default destroys governments, the system almost always chooses the quiet one. That choice forces hard assets to reprice, not as a trend, as a consequence. Now let me give you the authority check in plain language, because you should never take a claim like this on faith alone. The Institute of International Finance tracked global debt reaching a record $348 trillion at the end of 2025, after roughly $29 trillion was added in a single year. The U.S. Congressional Budget Office projects multi-trillion-dollar deficits continuing into the mid-2030s, with federal debt rising toward 120% of GDP by 2036, and the World Gold Council reported that central banks added over 1,000 tons of gold in 2024, the third consecutive year above that threshold. 3 separate institutions, 3 separate data sets, one coherent picture: debt exploding, deficits normalized, central banks quietly hoarding metal. These aren't separate stories. They're 3 angles of the same structure, and once you see the structure, you cannot unsee it. Here's the spine of everything I'm about to tell you. When obligations grow faster than the productive base that must service them, the system eventually gets trapped. It can't let rates rise because rising rates blow up debt service and cascade into defaults. It can't cut spending enough because austerity is politically suicidal. So it takes the only path that spreads pain invisibly across time. It represses, rolls, and dilutes. And when a system dilutes for long enough, the measurement tool people trust most, price, starts screaming. That's what silver is doing right now. I'm going to show you the exact mechanism that creates these moves. Then I'm going to prove it happened 3 times across 3 different centuries. And only after we've earned the right to talk about the present, only then do we map the same pattern onto today. And I want to make you one promise before we go further. Near the end, I'm going to name the single mistake that destroys people in silver bull runs. It's not being wrong about the direction. It's something far more common and far more lethal: confusing insurance with a lottery ticket. If you understand that distinction before this cycle ends, you don't just survive it, you use it. The mechanism runs in 4 stages: fixed order, universal logic. The first stage is the setup. Money works. Contracts mean something. Institutions appear competent. People save and plan because the future feels stable enough to trust. This is the phase that makes everything that follows possible, because credibility, once established, can be spent. The second stage is expansion. This is where the system discovers the political drug called credit. You can spend without taxing. You can promise without paying. You can avoid conflict today by pushing pain into tomorrow. Debt grows faster than the real economy. But early on, it feels like prosperity. Nobody sounds the alarm because the drug feels like vitamins. This is the phase where the seeds of debasement are planted, sometimes in coins, sometimes in balance sheets, sometimes in temporary programs that quietly become permanent. The third stage is crisis and loss of control. The debt load becomes so large that honest interest rates become impossible. If rates rise to reflect real risk, the debt structure breaks. If rates stay suppressed, purchasing power erodes. Policy stops being leadership and becomes performance. Emergency measures become standard operating procedure. And people start noticing the gap between what they're being told and what they're actually experiencing. The fourth stage is the inevitable outcome. Real assets reprice upward as paper promises lose credibility. Not because society becomes paranoid, because math wins. The currency becomes the shock absorber holding the debt structure together, and hard assets absorb the pressure that the currency can no longer hide. Here's the critical thing. If you only read headlines, every move feels random. If you track the stages, every move feels inevitable. The mechanism is what separates the people who get surprised from the people who were already positioned. Now let's prove it happened before. 3 case studies, different centuries, different countries, same machine, Rome. Not the cinematic version, the administrative apparatus that had to pay armies, feed bureaucracies, and hold together an empire measured in millions of people and millions of square miles. Early imperial Rome had coinage with real silver content and real credibility. People accepted it for trade, for taxes, for wages. When money works, an empire can coordinate reality at scale. Then expansion happens. Borders stretch. Armies cost more. Bureaucracies swell. Political competition intensifies. And leaders discover the same lesson every overstretched government discovers. It's easier to buy loyalty with spending than to earn it through productivity. But if raising taxes invites rebellion, you adjust the money instead. The silver content in coins begins to shrink while the face value stays the same. The official stamp remains authoritative. The metal inside quietly disappears. This is the genius of slow debasement. It steals in increments small enough not to trigger immediate revolt. Over time, people notice. Prices rise because the currency is weaker. Merchants demand more coins for the same goods. Soldiers demand more pay because their pay buys less. The state responds with the only tool it has left: more debasement, more issuance, more coercion. Price controls appear, edicts against hoarding, punishments for those who try to protect themselves. But inflation isn't caused by greed. Inflation is a symptom of currency losing integrity, and no edict has ever repealed that math. Trust collapses. People retreat into barter, hard goods, local agreements. The official coin becomes something you try to spend quickly, not something you store proudly. Real assets become the sanctuary because the promise embedded in money has been broken beyond repair. Rome didn't stumble into this. The incentives led there. The machine ran, the outcome arrived. Weimar Germany, same machine, compressed into a brutal fast-forward. Germany had industrial capacity and functioning monetary institutions. Savings, wages, and contracts had meaning. Then war finances strain the state. After the war, the burden doesn't vanish. It transforms. Reparations create obligations that must be met in real terms while the domestic economy is barely breathing. The essence of Stage 2, claims grow larger than the capacity to pay them. The state turns to money creation to meet obligations and sustain domestic spending. At first, it feels like relief. Then prices rise. Then people adjust. Then they panic. And here's the psychological switch that turns inflation into catastrophe. Once the public realizes that holding currency guarantees loss, they spend it immediately. Velocity explodes. Money becomes a hot coal that burns whoever holds it longest. Policy stops steering and starts chasing. The currency dies as a store of value. People flee into foreign currency, commodities, durable goods, anything with scarcity. The wealth transfer is devastating. Savers are erased, debtors are quietly rescued, and real asset owners survive. This isn't ideology, it's structure. When the system chooses dilution to preserve solvency, the currency becomes the casualty. The people who held the most paper suffered the most. The people who held real things held on. The United States in the 1970s. This is the modern blueprint for what happens when a global monetary anchor breaks and real assets reprice across an entire decade. After World War II, the dollar had a gold link for foreign official holders. America had industrial dominance. Confidence was backed by production, not just declaration. Then deficits rise. Global commitments expand. Dollars flood abroad. Foreign claims on American gold increase. And here's the fundamental contradiction that makes Stage 2 inevitable. You cannot promise convertibility while issuing more claims than the gold you physically hold. That's a promise that was always going to break. The only question was when. In 1971, the U.S. suspends gold convertibility. The anchor is gone. The decade that follows becomes a live demonstration of Stage 3. Inflation surges, oil shocks hit, wage price spirals form, policymakers attempt controls, and the public begins to feel in their daily lives what the policy documents won't admit. The monetary promise has been broken. Real assets reprice dramatically across the decade. Commodities surge. Gold moves from $35 to over $800. Cash hemorrhages purchasing power. The cycle only resets when credibility is rebuilt through painful tightening, at enormous economic cost and years of suffering that could have been avoided if the machine had been understood earlier. Stop and absorb what those three systems share. Rome, Weimar, 1970s America, different technology, different politics, different centuries, identical four-stage sequence, setup, expansion, crisis, repricing. The mechanism doesn't care about geography, it doesn't care about ideology. It runs because the incentives are universal. The machine is the machine. Now we apply the pattern to the present. Cold audit, no cheerleading. The setup is already behind us. For decades, global finance lived inside an unusually stable regime. Disinflation, globalization, expanding credit. Central banks that successfully cultivated the belief that they could manage any shock. Markets learned that downturns would be met with support. People built lives on the assumption that money would remain mostly stable, that trust became behavioral. More leverage felt safe because rescue felt certain. That's the foundation. It existed, it was real, and it was spent. Then expansion. $348 trillion of global debt is not high, It's structural dependence. It means future income has already been pulled forward on a planetary scale. It means every government, corporation, and household that carries significant debt now relies on refinancing conditions staying friendly. It means the entire system becomes exquisitely sensitive to the price of money. In the United States, the core issuer of the global reserve currency, baseline projections show large deficits continuing and debt ratios rising for years. That means the system isn't planning to deleverage. It's planning to manage. It's planning to roll. It's planning to keep the structure standing by any means that don't cause immediate visible collapse. And now listen carefully, because this is where most people lose the thread. The danger is not that debt is large. The danger is that large debt removes options. It turns policy into a narrow hallway. Once you're in that hallway, you cannot simply choose discipline without smashing through walls that hold the political order together. Which brings us to the trapped stage. If rates rise enough to truly extinguish inflation, debt service costs explode. Governments face fiscal strain. Corporations face refinancing stress. Households feel credit tighten. Asset prices deflate. Unemployment rises. Political rage ignites. If rates stay suppressed to protect the debt pyramid, inflation persists and purchasing power erodes. Which is not just an economic problem, it's a social one. People don't riot because of charts. They riot because their lives get measurably smaller. So what does the system do? It chooses what preserves order in the near term. It smooths. It stabilizes. It uses new names for old tools. And the more it stabilizes the pyramid, the more it quietly transfers volatility into the currency itself. The currency absorbs the pressure, so everything else appears calm. This is where the official story and your lived experience diverge. You may hear strong economy while your costs rise faster than your comfort. You may hear inflation easing while your essentials don't feel cheaper. That gap is the system maintaining confidence while quietly absorbing pressure it cannot admit publicly. And when enough people feel that gap, when it moves from a nagging suspicion to a visceral daily reality, they seek protection, which is exactly why silver is where it is. In stage 4, silver doesn't just move, it can move violently, because silver sits at the intersection of monetary fear and industrial necessity. Gold is the quiet reserve asset, the one central banks accumulate for large-scale monetary insurance. Silver is the volatile bridge between money and physical industry. In a world electrifying everything, grids, panels, chips, vehicles, silver has industrial demand that doesn't disappear because investors are nervous. It intensifies because production intensifies. So in this stage, silver can get hit with two demand waves simultaneously: industrial necessity and monetary fear. And because the silver market is smaller than most people emotionally assume, it doesn't take broad participation to move it dramatically. It takes marginal flows, a shift of even a small fraction of global capital into hard assets, especially if it comes quickly, can overwhelm available supply at the margin. That's how you get violent repricings. That's how you get moves that look impossible to people watching without the framework. That's how you get silver past 90. Long era of trust and stability as the foundation. Check. Debt expanded to record levels, with deficits treated as the permanent baseline. Verified. Policy trapped between inflation and insolvency, choosing management over resolution. Undeniable. Hard collateral repricing as the currency becomes the shock absorber. That's where we are. Now, silver past 90 signals something beyond price. It signals that the safe haven trade is no longer a niche behavior. It's becoming mainstream again. And when safe haven behavior goes mainstream, the game changes. Because mainstream behavior is not strategic. It's emotional. It comes in waves. It arrives late. And it arrives with panic. This is why silver is simultaneously a warning and a trap. The warning, it tells you the system is late in the sequence. The trap, late-stage moves, create the illusion of a straight line. People see the move and assume it continues without interruption, and that assumption is where fortunes get destroyed. Which brings me to the mistake I promised you. The single thing that wipes people out in silver cycles, not because they were wrong, but because they were right in the worst possible way. They confuse insurance with a lottery ticket. Insurance means you acquire it before the crisis becomes obvious. You hold it through uncomfortable volatility, and the entire point is protection, not performance. A lottery ticket means you chase it after it's already moved. You oversize the position because you feel urgent, and you secretly expect it to solve your financial life in a single move. Silver rewards the insurance mindset. It punishes the lottery ticket mindset. And the painful irony is that the lottery ticket mindset feels more rational at the moment you enter it, because by the time silver is on the front page, there's genuine evidence it's moving. The momentum feels like confirmation. It isn't. It's the setup for the shakeout. Here's exactly how the trap runs in real time. Silver starts moving. The The public ignores it. Just a metal. It moves more. The public shrugs. Probably temporary. Then it hits a number like 90, and suddenly the public looks up and asks what is happening. They rush in emotionally. They buy because they feel late. That first wave of emotional buying is exit liquidity for the people who positioned early. Then volatility hits. Silver is famous for violent pullbacks even inside genuine bull runs. Weak hands panic and sell at the worst possible moment. The move resumes. They re-enter higher. The cycle repeats until their emotional capital is exhausted and their financial capital has been transferred to more patient hands. This is how people lose money while being right about the direction. It happens in every cycle. It will happen in this one. The framework that keeps you alive is simpler than most people want to believe. Stop thinking in single predictions and start thinking in regimes. A stable regime rewards paper claims. A late cycle regime rewards collateral. Your job is not to guess tomorrow's price. It's to recognize what stage the system is in and position accordingly. Treat hard assets as a structural role in your strategy, not as a personality or an identity. Size them so you can hold through chaos. If you're checking the chart every hour, your size is wrong. If you can't sleep, your size is wrong. Stage 4 volatility will find your specific weakness and exploit it with precision. And understand that stages 3 and 4 create relentless narrative whiplash. One week the story is soft landing. The next, it's systemic crisis. That's not contradiction. That's late-stage reality. The system is managing too many constraints simultaneously. It oscillates between them. If you can remain calm through the oscillation while others panic, you are already ahead of the majority. There's one more thing we have to address, the most comfortable lie that keeps people passive until it's too late. This time is different. People say American exceptionalism makes the United States immune to monetary consequences. But arithmetic has never been impressed by flags. People say technology will save us, and it might raise productivity, but it also accelerates leverage. Tools accelerate both construction and collapse. People say central banks are smarter now, but intelligence without the political freedom to accept painful outcomes is just a better explanation for the same result. If the political system cannot absorb the pain of honest defaults, the currency becomes the buffer. That's not a failure of intelligence, it's a constraint on options. This time is not different. It is the same pattern wearing modern clothes. And silver past 90 is what the pattern looks like when it is no longer subtle enough to ignore. The warning is structural. When debt and promises expand long enough, the system must resolve the tension. If it refuses open default, it chooses quiet default. Quiet default is dilution. Dilution is repricing of real assets. That's why the safe haven trade comes back, not driven by fear alone, but by structure, by math, by the same sequence that played out in Rome, in Weimar, in 1970s America, and in every system before them that reached the same junction and made the same choice. Position yourself like someone who understands the machine, recognize the regime, hold protection with discipline. Don't chase what has already moved with capital you can't afford to see volatile, and when the pullback comes, because it will come, because it always does, know whether you're holding insurance or a lottery ticket. That distinction, held clearly in your mind under pressure, is the difference between using this cycle and being used by it. Stop looking at the chart. Look at the debt. Look at the deficits. Look at the incentives. Then ask yourself one honest question. In a system that cannot tolerate honest interest rates and cannot accept open defaults, what else can it do besides sacrifice purchasing power and reprice real collateral? That's why silver is screaming. And that's why the people who understood the machine before the headline are already where the people reading the headline wish they were.